Module 1 of the Mifid Stay Compliant program. My name is Marianne Mardenborough and I've been with KPMG for 4 years, working as an advisor within the risk and regulatory practice. In Module 1, I will give a brief explanation of what the benchmarking regulation entails. Then I will touch upon the main requirements stipulated by the benchmarking regulation. And lastly, I will discuss the consequences the benchmarking regulation has had on financial markets. In the financial industry, benchmarks such as LIBOR and EMIR were used in many products and contracts to determine price or to measure performance. In the wake of the alleged manipulation, the European Parliament, in conjunction with the Council, have adopted new rules to improve the governance of benchmarks produced and used throughout the European Union. The benchmark regulation, also known as the BMR, establishes a common regulatory framework seeking to ensure benchmarks are produced in a robust and reliable manner and to minimize conflicts of interest in the benchmark determination process. The regulation impacts indices across asset classes, including equity, fixed income, commodities, and interest rates. The benchmarking regulation entered into force in June 2016 and came into effect on January 1, 2018. In order to prevent conflict of interest and benchmark manipulation, the BMR defines controls for benchmark processes and sets requirements to advance the quality of input data and methodologies used for benchmarks. What is a benchmark? A benchmark is an index used for two purposes, as defined in the BMR. The first category includes indices used to determine the amount payable under a financial contract or a financial instrument. Examples include adjustable mortgage loans, consumer loans, where the amount payable is often determined using a benchmark like the LIBOR rate. The second category includes indices used to measure the performance of an investment fund for the purpose of tracking the return, computing performance fees, or defining the asset allocation. A very important characteristic of an index is that they are published or made available to the public. Availability to an indeterminate number of recipients is not necessary. Even when an index is produced to accommodate tailor-made needs for a specific user, also known as customized benchmarks, they will come under the scope of the BMR if they are referenced by an investment fund. An example is where an investment fund computes its performance fees based on a benchmark like the FTSE Emerging Index for equity-related investments in emerging countries, but modifies the benchmark to exclude companies that do not align with their ESG criteria. These customized benchmarks also come under the scope of the BMR. The scope of the benchmark regulation covers benchmark administrators, supervised contributors, and benchmark users. The BMR allows supervised financial companies to use only those benchmarks which are authorized and thus included in the register of the European Securities and Markets Authority, also known as the ESMA. Before a benchmark can be listed in the ESMA register, it will have to comply with requirements stipulated under the BMR. These requirements vary with the type of benchmark. The BMR distinguishes between critical, significant, non-significant, regulated data, interest rate, and commodity benchmarks. A benchmark administrator is an entity that provides indices that are used in financial instruments traded on trading venues in the European Union, mortgage or consumer credit contracts, or investment funds. Examples of well-known benchmark administrators include Euronext, MSCI, JP Morgan, and Bloomberg. A supervised contributor, on the other hand, is an entity authorized by a competent authority like the AFM to contribute input data that is not readily available to the administrator and that is required for the determination of a benchmark and is provided only for that purpose. Examples include banks that provide transaction data that helps determine the interest rate for specific loans. Lastly, you are considered a benchmark user if you're supervised under one of the European regulations as specified in the benchmark regulation, and you issue a financial instrument which refers to an index or a combination of indices, or you determine the amount payable under a financial instrument or a financial contract by referring to an index or a combination of indices, or maybe you're a party to a financial contract that refers to an index or a combination of indices. Or maybe you provide a borrowing rate calculated as a spread or markup over an index or a combination of indices. Lastly, you are also considered a benchmark user if you measure the performance of an investment fund through an index or a combination of indices for the purpose of defining the asset allocation, tracking the return, or computing performance fees. Examples of well-known benchmark users are pension fund service providers, such as PGGM or MN, banks such as ABN AMRO, or investment firms like De Giro. What is not considered benchmark usage? Well, the act of simply holding products that refer to an index, in the case of investment funds referring to a benchmark for performance comparison or marketing purposes, does not constitute benchmark usage. And what products come in scope of the BMR? While not all financial products fall within the scope of the BMR, the most common include structured products, derivatives, certain credit agreements, and collective investment funds like UCITS and the alternative investment funds. Examples of products not in scope of the BMR include insurance products and cash deposits. The BMR imposes requirements on benchmark administrators who effectively provide the benchmarks, on contributors, and on users. Different requirements apply to each. What are the requirements for benchmark administrators? Administrators should first obtain registration or authorization with the applicable national competent authority. For the Netherlands, this means the AFM. They should also provide benchmark statements with applicable disclosures, including key elements of the methodologies, and in addition, they should also implement contributor codes of conduct and maintain adequate systems, controls, governance, and oversight, including managing conflicts of interest. Lastly, they should also ensure the integrity and reliability of the input data. What are the requirements for benchmark users? As a benchmark user, you will have to comply with various requirements on contingency measures, control framework enhancements, and disclosures. Benchmark users must ensure that they only use benchmarks that are provided by benchmark administrators included in the ESMA register. This means you have to assess all your products to determine which of them come under the scope of the BMR. In addition, you should also establish controls around the use of those benchmarks to ensure that you only use benchmarks provided by BMR-compliant administrators. When it comes to contingency measures, users need to have robust written plans setting out the actions that they would take in the event that the benchmark materially changes or ceases to be provided. Where feasible and appropriate, such plans should nominate one or several alternative benchmarks that could be referenced to substitute the benchmark no longer provided. This means that you should establish a process to ensure an alternative benchmark is defined whenever a new product is launched. In addition, controls should be established to periodically review the suitability and the BMR compliance of these alternative benchmarks. Benchmark users should also add a disclosure to the relevant product prospectus stating that the benchmark is provided by an administrator included in the ESMA benchmark register. What are the requirements for benchmark contributors? Supervised contributors are required to comply with governance and control requirements, which translates to having codes of conduct and control frameworks in place. How has the BMR impacted financial markets? When we look at the interest rate benchmarks, for example, we observe that in 2019, all significant interest rate benchmarks like Euribor and LIBOR used in the European Union have been recognized as BMR non-compliant. Therefore, these interbanks offered rates, also known as IBORs, will be migrated to risk-free rates in January 2022. Currently, international regulatory initiatives and working groups in different jurisdictions are defining risk-free rate candidates like Ester as possible replacements to IBORs, the interbank offered rates. The Ester rate is based on actual volume-weighted transactions, which makes it very hard to manipulate. LIBOR, on the other hand, is determined as the average interest rate calculated through submissions of interest rates by major banks across the entire world. As we've seen with the LIBOR scandal, banks were falsely inflating or deflating their rates to profit from trades or to give the impression that they were more creditworthy. Hence, it makes more sense to move towards benchmarks like Ester in order to prevent future benchmark manipulation. The transition away from existing IBORs has a wide impact for financial institutions due to its incorporation within a broad range of financial instruments used across various market participants. LIBOR rates, for instance, affect us both as consumers and as investors. LIBOR is the reference rate used for many different types of loans, including adjustable rate mortgages, auto loans, and credit cards. Unless a backup rate is listed in a contract, the new rate and terms will need to be agreed upon between the borrower and the lender. Existing contracts therefore have to be converted to alternative benchmarks. As you can imagine, this will come at a very significant operational and legal burden. The BMR will come fully into force When a transitional period for the use of existing critical interest rate benchmarks of index providers that are not yet subject to the supervision ends on January 1st, 2022. This means that the existing benchmarks, even after possible reforms, are no longer suitable for use in long-term contracts. This applies to both existing contracts and to contracts that will be entered into as of January 2022. In addition, if benchmarks used in existing contracts will no longer be offered, a suitable alternative must be ready for use. Therefore, identification is required for the complete population of products, contracts, models, and activities that directly and indirectly depend on IBORs. In a survey conducted by the EFM and DNB, market participants indicate that they perceive the transition to new benchmarks as a high-risk operation involving significant operational and legal burden. Given the uncertainty surrounding the transition and its impact on different types of customers, most institutions are still reluctant to inform their customers about the transition. To conclude, we would recommend parties affected by the BMR to conduct a qualitative assessment as a first step to determine the materiality of the impact. Based on this materiality assessment, a further more detailed quantitative impact assessment should be executed to consider exposures and number of impacted contracts, clients, and trades, impacts to system models, and such. Welcome to the second part of Module 1. In this section, I will provide a general description of the influence that current developments pertaining to the European Market Infrastructure Regulation, also known as EMIR, have on the centralized and bilateral clearing of derivatives. Then, I will explain how parties active in the institutional investment market can incur a counterparty risk when unwinding derivative positions, and how to mitigate this risk. Next, I will list the supervisory issues for the AFM and DNB and describe current developments pertaining to these topics. And to conclude this section, I will explain the influence these developments may have on day-to-day advisory practice. The global financial crisis that started in 2007 gave the regulators the opportunity to investigate the causes of the financial crisis. They have identified over-the-counter transactions in derivatives, also known as OTC derivatives, as one of the potential causes to the global financial crisis, and therefore came to the conclusion that this market should be secured. A derivative is a contract that derives its value from the performance of an underlying entity. This underlying entity could, for instance, be an asset, an index, bond, currency, or an interest rate. Derivatives can be traded on an exchange like the Eurex or over the counter between two contracting parties. The consensus among regulators was to move all standardized derivative contracts that were being traded over the counter to a central clearing party, also referred to as a CCP. A CCP positions itself between the buyer and seller as soon as a transaction has been executed. The CCP thus becomes the new counterparty of both the buyer and the seller, hence the name central counterparty. As a consequence, the relationship between the two original parties no longer exists. The seller will sell the contract to the CCP and the buyer will buy the contract from the CCP. This will introduce an effective monitoring, since the CCP can stipulate the required collateral and monitor the positions of the two parties under new regulatory rules. This new infrastructure implemented for the OTC derivative market can reduce the global counterparty risk observed in the OTC market considerably. How does this tie to the European Market Infrastructure Regulation, also known as EMIR? Well, EMIR, in a quest to be more transparent and reduce risk, has introduced new obligations for derivative trading companies. These obligations include trade reporting of all derivative contracts, meaning over-the-counter and exchange-traded derivatives. In addition, EMIR has also introduced mandatory centralized clearing of all standardized OTC derivatives, risk mitigation techniques for non-centrally cleared derivatives, and enhanced collateral requirements. OTC derivatives are contracts that are privately negotiated between two parties without going through an exchange or intermediary. Products such as swaps, forward rate agreements, exotic options, and other exotic derivatives are almost always traded in this way. Since OTC derivatives are privately negotiated contracts, they typically lack transparency, as any information concerning them is only available to the two contracting parties. This creates a complex web of interdependence, which can make it difficult to identify the nature and level of risks involved. The financial crisis has demonstrated that such characteristics increase uncertainty in times of market stress and accordingly pose risks to financial stability. It is therefore important that counterparties and CCPs report all details regarding derivative contracts they've entered into to trade repositories. Trade repositories are essentially entities authorized by national supervisors like the AFM that centrally collect and maintain the records of OTC derivatives. As a result, information on the risk inherent in derivatives markets will be centrally stored and easily accessible for European oversight authorities like the ESMA. How has EMIR impacted the trade in OTC derivatives? Keep in mind that under EMIR, 5 types of derivatives are recognized: credit derivative contracts, equity derivatives, interest rate derivatives, foreign exchange derivatives, and commodity derivatives. EMIR requires all standardized OTC derivatives contracts to be cleared by a central clearing party. In addition, all OTC derivative contracts should be backed by collateral. EMIR requires collateral to have low levels of market risk and credit risk. Minimum criteria for eligible collateral of each asset class have been specified under EMIR. EMIR also introduces stricter segregation criteria for client money, with clearing members and central clearing counterparties (CCPs) required to offer either omnibus segregation or individual client segregation at the minimum. In addition, OTC derivatives that are not standardized and hence cleared non-centrally should be subjected to enhanced risk mitigation techniques. Finally, financial companies impacted by EMIR should report daily trade and position of all derivative contracts to trade repositories, and derivative contract records will have to be kept for at least 5 years after contract termination. Under a new regulation known as EMIR 2.2 that came into force in January 2020, the European Union tries to enhance the regulation of CCPs amid concerns regarding potential CCP failures, given their increasing systemic importance. If you look at the market for clearing of Euro OTC derivatives, for instance, London's LCH ClearNet is responsible for clearing 97% of euro-denominated interest rate derivatives. After Brexit, some of the CCPs, which are of systemic importance to the European Union, will be located outside of the Union's borders. That could be troublesome, especially when laxer regulation and supervision creates a favorable playing field for CCPs in third countries at the expense of CCPs in the European Union. So in a way, EMIR 2.2 is trying to level the playing field by preventing what we call supervisory arbitrage. How do parties active in the institutional investment market incur a counterparty risk when unwinding derivative positions? Derivative transactions are settled at a later time than that at which the actual trade took place. If in the intervening period either of the two parties is unable to meet its obligations, this could cause problems for one of the parties. So this is also known as counterparty risk. To see how this risk comes about, you could imagine a bank that hedges its mortgage portfolio against interest rate risk with interest rate swaps. An interest rate swap is basically an exchange of interest rates between two parties, typically where you exchange a floating rate for a fixed rate or vice versa. The bank could agree to lock in a fixed rate to avoid exposure to interest rate fluctuations in the future. During the closing out, the bank incurs some counterparty risk, as there is a chance that the swap counterparty might default on its contractual obligation. How is this counterparty risk mitigated under EMIR? First of all OTC derivative contracts, bilateral or centrally cleared, will need to be collateralized. Collateralization is the use of a valuable asset now to secure a future payment. If one party defaults on the future payment, the other party may seize the asset and sell it to offset the loss. EMIR has also introduced new risk mitigation procedures for non-centrally cleared OTC derivatives. This means that parties should have arrangements in place to ensure timely confirmation of uncleared OTC transactions. Also, formalized processes need to be in place in order to reconcile portfolios, manage the associated risk, and identify and resolve disputes between parties, and to monitor the value of outstanding contracts. Parties should mark the market on a daily basis to determine the value of outstanding contracts. Lastly, they should have risk management procedures that require the timely and accurate segregated exchange of collateral with respect to OTC derivative contracts. To sum up, it should be noted that EMIR is a very dynamic piece of legislation. While introduced back in 2012, it has been updated many times. A recent update, known as EMIR Mifid, is expected in June 2020, which essentially holds financial counterparties legally liable for the timely and accurate reporting of OTC derivative contracts on behalf of both themselves and their non-financial counterparty clients that don't meet the clearing threshold. This requirement raises several operational challenges and points to be considered by both financial counterparties and non-financial counterparties. To conclude this section, I will briefly touch upon the supervisory calendar for 2020. In other words, which topics are currently keeping supervisors like the AFM and DNB busy, and how are these developments likely to impact day-to-day practice? The AFM and DNB have deemed a couple of supervisory teams as priority teams for 2020. In this last section, I will briefly touch upon 4 of these topics, starting with digitization. Although digitization is considered a good thing, it also demands attention to the risks involved. On the one hand, we see that financial services in the digital domain are always available. Information and products can be personalized to the customer, and the threshold for ongoing contact between the seller and the buyer is low. This entails convenience, lower costs, and possibility for a better fit between supply and demand. On the other hand, increasing digitization also raises supervisory concerns, for example, around the ethical use of data. Secondly, supervisors will pay more attention to products and services with long-term impact in order to protect consumers in vulnerable situations. Supervisors will enter into a dialogue with the credit lending sector to avoid future problems with interest-only mortgages. The influence of a low interest rate environment on lending to consumers will also be examined. Credit providers can expect tighter supervision of compliance with their duty of care. Furthermore, the supervision of individual entities will shift in the coming years towards the asset management market as a whole. Also, the cost structures used by asset managers and risks involved in the outsourcing of activities by asset management parties will receive increased attention. The objective for the next 2 years is to ensure asset managers have a sustainable business model and to ensure their clients are treated carefully. Lastly, DNB will increase its focus on climate risk as part of its supervision on the internal risk assessments of banks, insurers, and pension funds. Where appropriate, climate risks will be made part of future on-sites, and DNB will continue to raise these issues in the regular supervisory interviews.